Well, today I'm talking with Grady Vanderhoofven. Grady is president and CEO of Three Roots Capital here in Knoxville. Grady's been in the area for a while, spent some time in Oak Ridge area. Grady, you know Knoxville. I know that you didn't go to UT, but you're very fond of UT. You've been around the school and a couple of kids who've been through UT. So welcome to our series, and thanks for your time today.
You're welcome. I'm happy to participate. I look forward to it.
Yeah, I just want to cut to the chase. I'm learning as we speak about what you do. I'm learning about a lot of different firms around the area. So Three Roots Capital. I did not know the name Three Roots Capital until 6 months ago when we started talking. So what is Three Roots Capital? What do you all do? What are you about?
Sure. Three Roots Capital is a finance company. I'd say we're an innovative finance company. We're actually a nonprofit financial institution. We make loans to and investments in small businesses and projects, commercial real estate projects. And we're certified by the U.S. Treasury Department as a community development financial institution, CDFI. And as such, we're able to raise money from banks that require Community Reinvestment Act credit. Banks are required to have Community Reinvestment Act credit, CRA credit, by their regulators. And banks receive CRA credit when they work with CDFIs. So we raise money from a number of sources, one of which is banks. And then we loan or invest that capital to companies and projects, with an emphasis on companies and projects in low and moderate income areas. So there's an economic development aspect of what we do. As a nonprofit, I like to say that that's a tax status and not a business strategy, because if you're in the investment business, you have to make money to stay in business, but we don't have shareholders. And so we don't have to make distributions to shareholders. We're able to recycle our gains and reinvest them in the communities where we do business.
So yeah, it's a very interesting structure, because you do things sort of as a business model, sort of like perhaps a bank would do, or perhaps maybe even a mutual fund or some investment fund would do, but you're operating in this not for profit space. So your footprint, is it just East Tennessee, or is it a little bit bigger than that?
It's primarily East Tennessee. So we're certified, as I said, by the Treasury Department, and our official target market is all of the counties in East Tennessee and 4 counties in southeastern Kentucky. We, however, have some flexibility to invest outside of that footprint. We need to invest 60% of our capital and do 60% of our deals within our footprint, but the other 40% of our deals and the other 40% of our capital can be invested literally anywhere. So we have some flexibility, but the center of the target for our operation is East Tennessee.
So just in terms of kind of the way to think about what you do and where you fit into our economy, at a very high level, oftentimes we'll start with my students and talk about the idea of just a sole proprietorship. So someone starts a business. We've got a single owner manager business, and we can show some slides so our viewers can look what I'm talking about. But basically, you've got an investor and a manager and a business that are all sort of fused together, and so that's a sort of a self-funded enterprise, which the vast majority of businesses in America are exactly that. They're these small businesses. But at some point, for whatever reason, that no longer works. Oftentimes, it's due to the owner is unable to scale up anymore without new funds. That's one reason. Others could be expertise or the lack thereof, or wanting to change some things. But something happens, and then sort of the other end of the spectrum that we think about in our economy is sort of the traditional U.S. corporation with you've got complete separation between, you've got all these little shareholders on one side, they're providing the funds, you've got the firm's operations somewhere else, and the firm is its own legal entity. And then somewhere in the middle, there's managers and employees of the firm. But at the end of the day, in that setup, something has to happen to take the funds from the investors and sort of transfer them to the firm. And so there's a lot of matchmaking that happens, a lot of structuring of deals and things like that. And so again, that's really two extremes. So where is Three Roots in that mix?
Yeah, that's a great question. And of course, you talked about the two extremes, and then there are some gradients in between, right? And so Three Roots, as a nonprofit, we're not a sole proprietorship. We don't have any shareholders. We don't even have one shareholder. So the organization exists purely to provide capital to third parties. Whether those are businesses or real estate projects or the construction of a community facility. We'll invest in startup companies, and we'll make loans to larger commercial real estate projects. We could fund the construction of a hotel, and we fund the construction of a corporate headquarters, and we've also invested in companies that were started by an entrepreneur in their garage, or based on technology licensed from the University of Tennessee or Oak Ridge National Laboratory. And so we support those companies with capital that we raise from other sources, whether it's banks. We have capital we've raised from the U.S. Department of Agriculture that we use to make loans to small businesses in rural areas. We have capital that we've raised from the Economic Development Administration, which is in the Commerce Department. We have capital we've raised from the Treasury Department. We have capital that we've raised from this litany of banks. And then we have retained earnings. When we successfully deploy the capital and we generate a return, we have retained earnings, and we invest that capital. So we're raising capital from investors to invest in companies that we don't own. Right? We might make a loan, or we might make an equity investment. Now, if we make an equity investment, we might buy a little piece of the company, but we're not an operating company. We're a finance company. We're a financial institution. So we act as an intermediary to a certain extent between investors and investees. And like I said, we do invest some of our own capital, but we're not an operating company. We're an investment company.
Yeah. I mean, in a nutshell, in our economy, we've got lots of folks who have ideas and talents and potential products and projects, and they need funds. And we got a lot of folks that have funds that they need to invest. And you're basically, I would say, putting them together. And so this is really a lot of the sort of the glue, or the avenue to get things going. We've talked in the past, you and I, about sort of your desire and your mindset to not only think about local firms, places where the money is invested, but actually having the capital come from local sources. And so this idea of local capital and local investments and putting them together, that's kind of that seems to be kind of your passion and your bread and butter. And so can you talk a little bit more about why that's important to you, and how you're seeing fruit there?
Yeah, absolutely. My observation over the last 20 years is that investors tend to invest within some radius of where they live, where their office is, where they operate. And so it's possible to raise capital from far away and have it managed locally. But capital is going to be invested generally within some proximity of where it's being managed. An example is just a simple example. Think about all of the venture capital that's invested in California. About 100 times as much venture capital is invested in Silicon Valley as is invested in Tennessee. Why is that? It's because most of the venture capital is managed in Silicon Valley. It might be raised from investors all over the country, but it's managed in Silicon Valley. And so there's a huge amount of capital flowing around out there. The venture capital firms that are located there are investing there. New York and Massachusetts, Boston are the same. New York there's probably 30 times as much investment venture capital in New York. Massachusetts, there's probably 24 times as much. It's because there are more investors, there's more capital. Our observation is, and that's part of how I got into this business, we found that and I was involved in some efforts to create local companies. And what we found was when those companies needed to raise money, if they didn't raise money locally, they didn't stay in this area. They would relocate to where their investors were. And it's just, it's a practicality thing. It's easier to raise money in places where there is more money. It's easier to raise money for a company, for a project, in a community where there are investors who are actively seeking to deploy capital. And I think one of the keys to having a really healthy entrepreneurial economy in East Tennessee is we have to have investors in East Tennessee, ideally who are raising capital in East Tennessee, but the investors at least have to be here. And if you think about the way wealth is created, if we raise capital elsewhere, let's say we raise capital in Europe and we bring it into Knoxville and we have it in our fund and we manage it and we invest it locally, when that capital generates a return, the return goes to the investor in Europe, not the investor in Knoxville. So wealth is being created, the company is being supported, and that's good. And wealth is being created, but the wealth is flowing back out through the pipe that the capital flowed in through to get to us.
Yeah.
So to me, it's a perfect storm if you have local investors and the money is managed locally and the capital is invested locally. Now you can't get hyper local in terms of investing because there's, from a portfolio management perspective, you need to have a little diversity of where you're investing. But conceptually, local investors, local management, local investment, it's kind of a virtuous cycle.
Mm-hmm. And I mean, if we think about just general growth in this area, general development in this area, lives overall being made better.
Yes.
That's sort of I don't know if you want to call it a byproduct, but it's definitely a result of these types of efforts, right? Because there are a lot of beneficiaries well beyond the firms involved in these transactions.
Absolutely. And the compounding effect of successful companies, if you think about high quality job creation, you think about production of goods and services that are beneficial in the community. Now, maybe they're beneficial in the immediate community, and there's a lot of a restaurant in a neighborhood produces goods and services that are consumed in the neighborhood. A manufacturing company in the same neighborhood might produce products that are consumed nationwide or worldwide. But selling those products and services results in an inflow of capital into that business, which they then use to hire people, to buy goods and services in the community. And some wealth is created if the business is successful, and that those gains flow into the pockets of those investors or lenders who hopefully are also in that community. So it's really a compounding effect of having a successful business supported by lenders and investors that are in that same community.